Hi, this is Adiel Gorel. Very excited to be on Brian's show. And I am even more excited about sharing the greatest financial gift in the world that exists only in the United States. Can't wait.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 476. Real estate is one of the most powerful tools for building long-term wealth, but success depends on a strategic approach. My guest today, Adiel Gorel, has over 40 years of real estate investment experience and has helped thousands of investors achieve financial security. As the founder of ICG Real Estate Investments and author of Remote Control Retirement Riches, Adiel is a recognized expert in creating wealth through real estate. With a popular public television show and a TEDx talk with over 1 million views, Adiel's insights offer proven methods for securing your financial future. Adiel, welcome to the show.
Good to be here, Brian. Thank you very much.
Tell our audience a little bit about you and your experience in real estate investing.
My background is actually all in high-tech and electrical engineering and computer science. I'm a Silicon Valley guy by background. And I did my graduate studies in Silicon Valley, and I even taught at the university. Then I got my first job in one of the large Silicon Valley tech companies. And you know what happens to a young person who gets out of the university and gets a job in Silicon Valley? They usually say, whoa, they're paying me so much. That was my impression, at least. And then some of my colleagues in that research lab that I was working at were in their 50s and 60s. And I was a young guy. I looked at my colleagues and said, whoa, they must be so wealthy by now if they've been working here for 30 years. Getting paid like that. But once I got to know them socially, I discovered they were not wealthy at all. They were okay, they owned a home and a 401k, but that was it. I said, no way am I going to work here for decades and look like that. So I grew up in a family of real estate developers, so I was exposed to the power. Even though as a child, I didn't really care what my family did. I just wanted to play. But I said, look, here I am. I'm young, single. My expenses are very low. I get paid very well. My credit's great. I'm going to build an empire for myself so that when I get to 50 or 60, I will look much stronger than these guys. So I was living in Palo Alto, right there in Silicon Valley next to the university. And I followed the unwritten rule that was in the 1980s now. So the unwritten rule that everybody was following. Only buy rentals within 30 minutes drive of where you live. That's what everybody was doing that. So I was doing it too. I followed the crowd. So I was living in Palo Alto, buying in Silicon Valley. I bought a home, I bought another one. And after a few properties, I realized that I couldn't build an empire in Silicon Valley. Because even in the 1980s, although the numbers were much lower than they are now, the bad ratios between rent and price were similar. The rents were too low. So he said, well, if I really want to continue and build an empire, I got to break that 30-minute rule. So I did a little research. Well, in the 1980s, we didn't have the web. And Sergey Brin and Larry Page were in kindergarten. But I still had a research that I was doing at the lab at Stanford, and they had the ARPANET, the precursor to the internet, not as convenient. So with a little search, I discovered if I flew an hour and a half away from San Francisco, now I'm going, out of state, I would get to a smaller city by the name Las Vegas, which many of us know. And I discovered, to my surprise, I could buy homes in Vegas that cost about 1/4 of the value of the homes I was buying in Silicon Valley. And yet the rents were more like 1/2 of the Silicon Valley rent. That was infinitely better. I started flying there every weekend. Well, I always looked younger than my age. Back then, I looked like a boy. And the people in Vegas had never seen a person buying far from home like this. So everybody was very skeptical. They thought I was going to waste their time. So I spent my first month or two hunting for a local property management firm. Because obviously, if I was living in California, I was going to be buying in Nevada, I needed a local property manager to handle the properties I would be buying. So after a couple of months, I had a property management firm that I liked. I was still very nervous because I never got a chance to really test them in the field. Finally, a local broker took pity on the crazy boy from, out of state and said, okay, I'm going to look for homes for you. And I started buying. So I was always quite aggressive. And in the first year in Vegas, I bought 22 homes. Now, before people get impressed by that number, I have to be fair. The average home I was buying in Las Vegas in the 1980s cost $39,000 for the whole thing. And Fannie Mae back then didn't have the 10 loan limit like they do now. There was no limit. And I could easily buy homes as an investor with only 10% down with PMI or private mortgage insurance, which I did because I wanted to stretch my cash. So my friends in Silicon Valley made awful fun of me during that first year. What are you doing? Nobody's buying out of state. You're crazy. But after they saw me with my 20-something homes, the logic of the engineers started working. And they said, we see what you're doing. We want to do it too. And I said, you should. Go, do it. It'll change your future. And they said, come on. You work in Silicon Valley too. We don't even know how you fly to Vegas every weekend. We are so busy. We barely have time to go to the bathroom. How about you lead us? You're already there with your managers. Lead us, please. So I led a group of about 20 engineers. And over 3.5 years or so, we bought roughly 250 homes. Not as a group. She bought 6 homes for herself. He bought 4 homes for himself. I bought a few more. But I made the very trivial discovery that even the very cautious engineer who bought just 1 home as a test enjoyed, I could say, the power, the clout that came from 250 homes. Because if he wasn't happy, he would complain to me. And now, I wouldn't be happy. And every other manager in town was in touch with me. Come to us. We are better. We are nicer. We are taller. We are prettier. We are cheaper, whatever. Who doesn't want to manage 250 homes, plus the many dozens we may buy in the future? I started enjoying it a great deal because I felt not only was I changing my own future, and we'll talk about that more in a second, but I was helping all my friends change their future. Now, it was so unusual that I started getting invited to speak about it. And in one of the lectures to a big investor group in San Francisco, unbeknownst to me, there was a reporter in the crowd. So in the Sunday paper, there was a big article about all of this. And then I got invited to speak on the NBC Morning News, the local station. So I started saying, this is so much more fun. I quit my high-tech life, formalized it, formed a company. And for the past 40 years, we've been doing the same thing, except my investors now bought more than 10,000 properties. And 2,000 of them were bought by people from other countries and other continents. But the principle's the same. We go to a market, we identify where we want to buy. Of course, we'll talk about that. We interview property management firms. Now it's much easier because they all want to work with us because they know what kind of volume they can get. Local brokers, same thing. Give them the acid test. I buy homes from me, my staff, my veteran investors come in. So we buy 30, 40 houses to see how they are. doing their jobs. And if we like it, we want to work with them for decades and trust them and love them. And we have a lot of those. And so now we have cities where my investors bought 2,000 homes. And we even have one where they bought more than 3,000 homes. But the principle is the same.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. So you're working in Silicon Valley. The first year you go to Vegas, you buy 20 homes. Is that correct?
22.
What was the interest rate you were paying on the 90% leverage there?
As a precursor to the discussion of interest rates, I have to, with your permission, take a minute to talk about the reason why I'm not retired and the reason why I want a message to be heard. There's only one country in the world, to my knowledge, where there is an anomaly that exists. So people have made money in rental homes all over the world, in every country, throughout the history of time. But in this one country, there's a miracle. And nobody knows about it. I mean, people know, but they don't think about it. It's the biggest financial gift in the world. You know the name of that incredible gift, but most Americans were born into it. They think it's normal. The name of the gift is, drum roll, the 30-year fixed rate loan. So people say, what? Everybody knows that. Come on, that's nothing. Really? The only person in the United States that I've been in touch with before I explained why it's a great gift that got it is Warren Buffett. He was in touch with me in 2012. He gets it. And in the media, you can search. Sometimes he talks about, there's even an article about my interaction with him about it. Why is the 30-year fixed rate loan so magical? So we have inflation in the US, right? All the time, sometimes low, sometimes high. 40 years ago, we bought a postage stamp for 4 cents. Now, 72 cents. 40 years ago, we went to the movies in San Francisco for $2. Now, $15. If you go to a Whole Foods, let's say, and you buy a beautiful organic avocado, right now, $3. You know, I know, they know. In 10 years, very likely to cost $5 or $6, right? There's inflation. The dollar gets weaker and weaker. You need more dollars to buy the avocado, the tomatoes, the shoes, to pay rent, everything. In the midst of all this, somebody is insane enough to give you a loan that's pretty much going to be the only thing in the US economy to never, ever keep up with inflation. The tomatoes, the avocado, the shoes, the rents, the houses, the glasses, everything. Just your loan remains the same. That means inflation becomes your very best friend. It's not just a hedge against inflation, which it is. Inflation builds you wealth every month, every year, by really making the fixed value of your monthly payment, PI, smaller and smaller in real dollars, and the loan balance that you owe also doesn't keep up with it. In fact, it goes down with your principal, payment, but it never keeps up. That is such a miracle that when I speak in other countries, they don't believe that I know what I'm talking about. That it's too good to be true. The Americans don't see it. That's why I'm not retired, because there's a message that needs to be heard. When you get a 30-year fixed rate, and you don't have to wait for 30 years. So before I get to the rates, which I do, right? Here is a typical story. So I have a good friend, a retired doctor, retired thanks to these homes, actually. So he bought 19 houses. Again, at the time that he was buying them, we started after a few years buying only brand new homes. So he bought 19 brand new homes. At the time, he was paying about $150,000 per, putting the minimum down payment, not hard for a doctor. He started in his early 40s. He calls me up when he was 56. He said, hey, last year I turned 55. I looked at my 19 homes, and all my loans had 17 years left, not even halfway of the 30-year term. But I noticed that even though I bought them with a small down payment and my loans were very high to start with, in 13 years, my loans were just 1/4 of the value of my homes. That's what inflation does to the only thing in the US economy that never changes while everything else does. So he said, I was ecstatic because over 19 homes, I had millions of dollars in equity. Great. But then I took 4 of the 19 homes, sold them. I didn't do anything fancy, no 1031 exchanges, nothing, just sold and paid my tax. Used the proceeds to pay off the remaining small 15 loans. And with 15 free and clear homes, I retired at 55. Thank you so much. And then he adds the sentence that every one of my investors always says in the future, I should have bought more. Everybody said, even I, and I bought a huge amount. Everybody says that. So now, the interest rates. When I started buying in Vegas in the mid-1980s, the interest rates were 14%, 14. I put only 10% down. You don't have to be a great mathematician to know every one of these 22 homes that I bought started out with a negative cash flow. 10% down and 14% rate, negative cash flow. So I asked myself, can I sustain the negative? I said, yes, my salary is good, I can handle it. But I had another thought. Because it was clear to me about the miracle of the fixed rate loan, and that's why I waited until now, I said, even at 14%, my loan is fixed. The rents are not fixed. They go up with inflation, as the time goes by. So today it's negative. Tomorrow it's break even, which may be 2 or 3 years down the road. The day after it's positive, then more positive. That's exactly what happened. Except a couple of years later, the rates went down to 12. I refinanced everything to 12, it became positive. And then came the unforgettable day. The media was yelling and screaming, single-digit interest rates. We all ran out and refinanced to 9.95. What a day that was. And everything became super positive. That's why I don't need to go to stand-up comedy anymore. Because when I read in the media now, oh my God, the rates are 7. The world has collapsed. 7? Really? Historically, 7 is an unbelievably low rate. I understand that relative to the 3% that we had during the COVID era, it seems very high, but it's actually very low. But it doesn't matter. Let's say you buy a property today at 7% and you get a 30-year fixed rate loan. If you put the minimum down, which today is more like 20% really, you'll have either break-even-ish, slightly positive, slightly negative. But as you know, rents keep up with inflation as the years go by. The mortgage payment doesn't. But if the rates do go down in the future, let's say they go down to 4.75. I'm just making it up. Guess what you do? You refinance to 4.75. Now you can say, yeah, but refinance has a cost. Yeah, you calculate easily whether it's worth it or not. So, I mean, in fact, what the media doesn't know, because they're not in the field doing it, is the following. When the rates were super low during the COVID era, where a homeowner could get a loan for 2.5% and an investor maybe for 3.25%, the media, which makes everything 100 times bigger, was yelling, buy, the lowest rates. Everybody wanted to buy. Millions of people wanted to buy. The demand was very high. Prices shot up. We like to buy brand new homes. In fact, I wrote a series of articles, which I'll be happy to share with your listeners and viewers. One of them is why brand new homes. So I'm not going to go into it now. So we buy brand new homes from developers. So during the COVID boom, developers had limited supply and the demand was enormous. And I said, look, I have much more business that I can handle. I would rather be choosy. I don't want to work with investors, period. Only homeowners. I like homeowners better. They can get loans with 3.5% or 3% down. They love the home. No investor. So we could barely even buy anything. We had to be on waiting lists. Now, rates are closer to 7 or at 7. The media has told everyone the world has collapsed because the rates are at 7. Don't do anything, wait until they go down. So guess what? Demand is low. The supply is much better now. The builders are so friendly to investors. They love investors now. They give you gifts. And one of the gifts, ironically, is they buy down your rate. One of my friends just bought a home as an investment. The rate was 5.375. The builder bought it down as an incentive. So it's actually much cleverer to buy at a time like this when it's easy to buy, rather than wait until the rates go down in the future. The media will stoke the fire. Everybody will want to buy. Prices will go up. It'll be hard to buy. So buy now and refinance if they go down. That's the logic.
How long did it take you to reach financial independence with your Silicon Valley job there?
I started all of this when I was 29 years old. I could have retired, actually similar to my friend, about 13 years later, so at age 42. Today, I'm 70. So that means for 28 years, I work because I have a message that people need to hear. You have the biggest gift in the world, and you don't even see it. The 30-year fixed rate loan in the face of inflation.
Warren Buffett. So he called you up? What's that like?
Warren Buffett and I were connected in 2012 by a mutual business associate. He had said in 2012, even though he's a stock and company guy, not a real estate guy, he said the aftermath of the big recession is still here. And I believe it's good to buy a very large number of single family homes. We were connected, and he's so old school that I have correspondence from him with a pen and paper, which of course I saved. And he said, I want to buy 70,000 homes for Berkshire Hathaway, but I want to put 20% down on each one and get a 30-year fixed rate loan. And he says, I talked to Fannie Mae, they said I can only get 10. So whether you're a truck driver from Fresno or Warren Buffett, Fannie Mae, in its infinite wisdom, will only let you have 10.
What did he end up doing?
He ended up not going for it because his concern, which I tried to allay, was how do you manage 70,000 homes? And I laid out a plan to do it, but he didn't feel comfortable. He just thought it would be too unwieldy. So he didn't go there. Later, companies came in and started buying. As you know, they're doing it now. But at the time, it was a little premature. So he didn't buy the large number of homes, but the back and forth was quite enlightening.
Learn anything from him at that time?
I learned that he sounded very decisive. He certainly recognized the 30-year fixed rate loan as a great gift, which nobody else did. So he gets a lot of kudos because he's an American. He was born into it. Still, he saw that it's not normal. So, I mean, clearly decisive, sees the picture very well. He's a great guy.
Regarding that 30-year fixed loan, I mean, I've had guests on the show from Canada, and I think they have a balloon every 5 years. When I learned that, I was stunned.
Nightmare. And actually, that's better than many other countries. Many other countries, you buy a property, you get a loan, you make your payments very nicely, and a decade later, your loan balance is higher by far than what it started, and your monthly payment is almost double. Why? You kept up with inflation. It's only fair, actually, when you think about it. So this is an anomaly that we have in the US, and that's why I like to talk about it, write books about it, the TEDx, whatever.
Tell our listeners how they can find out more about you, get a hold of you. Feel free to plug anything you'd like.
Our website is ICG. By the way, it stands for International Capital Group. It's, ICG Real Estate. ICGRE.com. And I'll be happy to share the magazine articles, a link to the TED Talk. I was invited to do a PBS TV special that ran thousands of times in the whole country. And once a quarter, we have a big event where I bring the relevant market teams to talk about their markets. I take lots of questions. I bring lawyers and CPAs. It is now by Zoom, so everybody can join. The next one is on March the 1st. It's a Saturday. And you can register for free on our website, icgre.com, under events.
What did you do on PBS?
Somebody who heard about me from one of my investors works for PBS, and they wanted me to do one of those PBS special that you see. They put you on a stage with a crowd, and you explain what you explain. In the meantime, I wrote 2 books, and I prepared booklets and DVDs. They like DVDs. And they said, if you donate, to PBS, to the station, you'll get all the package that he had prepared. So the PBS show is there. I'll be happy to share a link to it. It was really fun. And it aired. It still goes from time to time.
What's your favorite hack or app?
My favorite hack is not to worry too much about the market, where you buy, and the details. The 30-year fixed rate loan is such a major thing. It's so dominant that as long as you buy a good new house that's decent, put the 30-year fixed rate loan on it, let the local manager lease it for you, and then proceed to do the hardest action for a human being to do. Nothing. You just wait. Between 12 and 14 years, usually, your loans look like a joke, like they're not really there, and you built your wealth.
Adiel, thanks for coming on the show today and talking about just the magical power of the 30-year fixed mortgage and how you've been able to leverage that to be able to retire early, but then also choose not to retire early and just keep going and sharing this with people. So it's been a real pleasure talking to you today. Thank you so much.
Same here, Brian. Thank you for having me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.